Welcome back to Degens Journal, your no BS, no hype source for the most important crypto stories you actually need to know. From Washington to the Eurozone, from Solana ETFs to Bitcoin cards in your wallet, today's headlines are packed with signal, not noise. So buckle up, Degens, because here's what's making waves. Headlines: Human Rights Foundation says Bitcoin is bad for dictators. Solana staking ETF could launch any moment now. Trump says Bitcoin relieves pressure on the US dollar. Only a few Bitcoin Treasury companies will survive the death spiral. Crypto cards outperform banks in small payments across Europe. Story 1. Bitcoin is bad for dictators, says Human Rights Foundation. Bitcoin is often framed as a risky investment, a tech experiment, or a tool for speculation. But for millions living under authoritarian rule, it's something far more vital. A tool for survival. That's the message Alex Gladstein, Chief Strategy Officer at the Human Rights Foundation, delivered loud and clear during the Bitcoin Policy Summit in Washington, D.C. this week. Speaking directly to U.S. political leaders, Gladstein explained how Bitcoin is dismantling the economic weapons used by dictators to control their populations. In many regimes, think Venezuela, Nigeria, Belarus, Iran, governments routinely freeze opposition bank accounts, block remittances, print money into hyperinflation, or track every financial transaction to root out dissent. But Bitcoin breaks that grip. With Bitcoin, the ability of these leaders to do these things is completely decimated, Gladstein said. Bitcoin is bad for dictators. And he's not exaggerating. In countries where trust in fiat has collapsed, Bitcoin has become a lifeline, a way for families to send money across borders, for dissidents to fund resistance, and for ordinary citizens to preserve their savings in something that can't be printed into oblivion or frozen by decree. Gladstein's warning isn't just philosophical, it's urgent. As central bank digital currencies, CBDCs, and surveillance tech advance, privacy is under siege, even in so-called free societies. Bitcoin's open, permissionless architecture is becoming one of the last bastions of financial autonomy. So while Wall Street debates ETFs and traders chase candles, this story reminds us, Bitcoin isn't just about making money, it's about keeping freedom. Story 2. Solana staking ETF is all systems go. Solana might be about to hit a milestone no altcoin has reached before a fully regulated, staking-enabled ETF in the United States. According to veteran ETF analyst Eric Balchunas, REX Shares has just filed an updated, finalized prospectus for its Solana staking ETF, and the signs are clear. This product is ready for launch. No redacted sections, no pending placeholders, everything is filled in. All systems go. If approved, this ETF would mark a massive leap forward. Unlike the Bitcoin or Ethereum spot ETFs, which simply hold the asset, this one would actively stake its SOL holdings, generating on-chain yield for investors. That's not just a structural tweak, it's a paradigm shift. Staking unlocks a new dynamic, passive crypto exposure plus native yield, all inside a familiar ETF wrapper. It merges the best of DeFi with the compliance and trust of TradFi. And it raises some serious questions. Will staking ETFs become the new standard for altcoins? Could this open the door for Ethereum staking ETFs next? And how will regulators treat yield-generating products going forward? There's also the geopolitical angle. If US investors can gain regulated access to SOL staking through Wall Street, that strengthens Solana's position as a legitimate financial rail, not just a speculative playground. This is no longer about meme coins or hype cycles. This is about financial infrastructure, and Solana is playing for real. Story 3. Trump says Bitcoin takes pressure off the dollar. In a surprising twist that would have been unthinkable just a few years ago, US President Donald Trump is now openly championing Bitcoin and framing it as a strategic asset for the American economy. During a press briefing at the White House on Friday, Trump praised crypto not only for creating jobs and innovation, but for something far more profound: relieving pressure on the US dollar. "It takes a lot of pressure off the dollar, and it is a great thing for our country," he said. Let that sink in. This isn't just a casual endorsement, it's a signal of a major philosophical shift at the highest levels of power. For decades, US presidents and policymakers treated Bitcoin as a threat to the financial system, to stability, to the dollar itself. Now, it's being reframed as a complementary force. Some analysts believe Trump was indirectly referencing the Triffin dilemma, the idea that countries issuing global reserve currencies face conflicting objectives: maintaining domestic economic health while supplying global liquidity. Over time, this pressure becomes unsustainable. From that lens, Bitcoin becomes a pressure release valve, a non-sovereign store of value that absorbs some of the global demand traditionally placed on the dollar. It doesn't replace the dollar, it supports it. Trump didn't mention CBDCs or stablecoins, both hot topics in the crypto policy world right now, but his stance was crystal clear. Bitcoin is not the enemy. It's a tool, and in his view, it's one that puts America ahead of China in the race for crypto dominance. Story 4. Most Bitcoin treasury firms are doomed, says VC report. Everyone wants to be a Bitcoin treasury company in 2025. From public miners to fintech firms and even AI startups, the playbook seems simple. Stack BTC, hold it on the balance sheet, and ride the hype. But a new report from venture capital firm Breed throws cold water on that optimism and outlines exactly why most of these companies are headed for collapse. According to the report, too many BTC treasury firms are trading at or near their net asset value, NAV, meaning the company's market cap is barely above the actual value of its Bitcoin holdings. That's a red flag. Why? Because it sets the stage for what Breed calls the death spiral, a brutal, self-reinforcing collapse that plays out in 7 phases. Bitcoin price drops. NAV declines in tandem. Share price falls to match NAV. Investor confidence evaporates. Liquidity dries up. Companies are forced to sell BTC. The firm collapses under pressure. This is not hypothetical. We've seen early warning signs of this spiral before during previous bear markets, when once hyped public miners and holding companies were forced to liquidate assets at the worst possible time. The only firms that survive, Breed argues, are those that command a multiple of NAV, meaning they're valued not just for their Bitcoin, but for their strategy, execution, leadership, and ability to generate cash flow. Think MicroStrategy with Michael Saylor at the helm, or CleanSpark with real mining economics behind it. In other words, holding Bitcoin isn't enough. Managing Bitcoin well is the real differentiator. The takeaway for investors? Don't just look at BTC on the balance sheet. Look at the company's brain and its spine. Story 5. Crypto cards are quietly winning Europe's everyday economy. While headlines scream about ETFs, meme coins, and regulatory chaos, a quiet revolution is unfolding where it matters most, at the checkout counter. A new report from CEX.io shows that crypto-linked cards are outperforming traditional banks in everyday spending across Europe, especially in the micro-purchase category. According to the data, a staggering 45% of crypto card transactions are under €10, a space historically dominated by cash and bank-issued debit cards. Think coffees, metro tickets, snacks, and impulse buys. Crypto isn't just sitting in wallets anymore, it's being used. But it doesn't stop there. The report also reveals that crypto card holders are nearly twice as active in online shopping compared to average European consumers. 21% of Eurozone card payments happen online. With crypto cards, it's 40%. That's not a fluke, it's a signal, a clear indication that crypto users aren't just speculating, they're transacting, and doing it in ways that show growing trust and comfort with digital assets as real money. And the trend is accelerating. CEX.io saw a 15% jump in new crypto card orders across Europe in 2025, pointing to a surge in demand as more people look for alternatives to the traditional financial system. Here's why this matters. Adoption without headlines. While politicians and talking heads debate whether crypto has real utility, users are buying lunch with it. Bankless payments. These cards bypass traditional accounts entirely, moving closer to a parallel payments infrastructure powered by blockchain. Organic growth. There's no hype machine here, no pump, no celebrity endorsement, just a tool that works. And perhaps the most ironic part? While central banks obsess over CBDCs and regulators drag their feet, crypto is already being used the way fiat was supposed to be. In the real world, for real purchases, by real people. The crypto revolution won't be televised. It'll be tapped, swiped, and confirmed. From Bitcoin fighting dictators to Solana hitting Wall Street, this week proves once again, crypto isn't slowing down, it's scaling up. Let us know in the comments. Which story matters most to you and why? Your word this week is dominate. Don't forget to like, subscribe, and hit the bell so you never miss what's next. This has been Degens Journal. See you in the next one.